Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 215. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rcraft@SNNWire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes and Spotify. It really helps provide feedback for me and spread the microcap message. Special thank you to our sponsors for today's episode, Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. And Quarter, whose mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's Quarter, QUARTR. We are excited to host our first in-person event in nearly 3 years. The Planet MicroCap Showcase is back in Las Vegas on May 3 through 5, 2022 at Bally's Hotel and Casino. It's time to see each other. It's time to network in person. Let's make it all happen in the entertainment and business capital of the world. For more information, please go to www.planetmicrocapshowcase.com. See you in Vegas. Now, for this episode of the Planet MicroCap Podcast, I spoke with Louis Camhi. He is the founder and chief investment officer at RLH Capital. We were introduced by Gary Ribe. He knew I've been wanting to do a SPAC episode for a while, and he delivered the perfect guest. Louis runs a SPAC-focused hedge fund and has been investing in SPACs well before the SPAC craze we've been experiencing today. According to the article, a record pace for SPACs in 2021 on NASDAQ, the total number of SPAC IPOs reached record highs in 2021, increasing to 613 from 248 in 2020. Compare that to just 59 in 2019. I know every financial content creator has done something in SPACs, and I'm no different here, but I think Louis provides really interesting insights into the evolution of SPACs, as well as his thoughts on what the future holds. Thank you again for tuning into episode 215 of the Planet MicroCap Podcast, and please enjoy my conversation with Louis Camhi. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And today's guest on the show is a gentleman who we were introduced by frequent guests on the show, as well as host of a podcast on the SNN.Network, Gary Ribe. So shout out to Gary. We got Louis Camhi on the show today. He's the founder and CIO of RLH Capital. And today it's all about SPACs, baby. That's it. We're going full deep dive into the history, where we're at today, where we're going forward, and how Louis really became interested in that. So with that, Louis, thank you for joining me today. How you doing, man?
Thanks for having me. I'm doing pretty well.
It's good to have you on. So before we get into our full-on SPAC discussion and, talking about everything having to do with that, love to know where your passion for investing began and how you got to where you're at today.
Sure. So I started investing at a really young age, call it 11, 12, 13. My family was really into the market. And so I would save up money and buy some stock here and there. And then, the dot-com bubble happened and all this money that I thought I had at the time disappeared. And so that kind of sparked a curiosity to learning more and more. And, the best tuition you can get in the market is losing money. And it's better to do that early on because you tend to have a lot less money. And even though it may feel like all the money in the world. And so, ever since then, I knew I wanted to study finance and went to school for finance and joined the finance world. But it really started from that really young age.
Very cool. So started then, catch us up to how you ended up doing it more professionally.
Sure. So I went to NYU for undergrad, studied finance and accounting, always knew I wanted to be on the buy side, but at the time, kind of the necessary stepping stone was to go through investment banking. So I joined Credit Suisse in the mergers and acquisitions group after school, spent about 4.5 years there. Great experience, great group of people, although I don't think any of them are there anymore with all the turnover going on. And then from Credit Suisse, I joined a firm that was starting up called Three Corner Global, which was fashion in a traditional Tiger Cub sense. The founder of that firm his name was Gunnar Overstrom. He was a partner at Maverick, running financials and business services. So kind of brought that same process over. That's actually where I invested in my first SPAC. So we can come back to that. And then, left that firm in 2018 to join Citadel. I was at Citadel for 2 years, and then decided that there's all this opportunity in SPACs and it'd be an interesting adventure to start RLH. And RLH is just named after my kids' initials. I just couldn't stand to come up with another cheesy hedge fund name. So I figured no one could hold that against me. And the fund now, we just only look at SPACs.
So, all right. So take me back to that moment when you were invested in your first SPAC. What was it about SPACs that caught your interest, caught your eye, to now where you have a fund that's specifically only investing in SPACs?
So at that point, I never heard of a SPAC. And actually, I had a friend who was working at one. And they announced a deal, and he goes to me and says, I don't know what I'm allowed to say or not say, but I think the deal we just did is really interesting and you should have a look. And so I looked at it kind of under this fundamental process that we had at Three Corner, and we ultimately liked it and ended up investing in it. But I also started studying the SPAC structure, and you have units that split into common and warrants, and how does that work? And all of a sudden I realized, wait a second, the warrants used to trade at 40 cents and now they're $2. That's much more interesting than the common. And so, started studying at the time and seeing that was what happened. You'd buy warrants back then for 40 cents. They would go to $1 on announcement and $2 on deal close. And I thought to myself, this is too good to be true. Anything in investing that's too good to be true isn't. So the next opportunity I came across, I invested $500 in the warrants, and lo and behold, it turned into $2,000. And it's like, okay, all the stuff we're doing at Three Corner, looking for, a differentiated view and your, variant perception and a path to profitability. That was really interesting. I love that, but this just seemed easy. And so, started kind of tracking all of the SPACs. And back then you could do that on a monthly basis, just you had your spreadsheet. There weren't that many of them. And over time, there were intersections in what I was covering versus some of these SPAC deals. So an example is there's a SPAC that merged with an asset called Repay Payments Company, which is, still public today. And I, always covered fintech and financials, cap markets. And so looking at a payments SPAC was right in my bread and butter. And in this deal, they announced the deal and the warrants were still trading at 40 cents. So I thought that was a tremendous opportunity, and, that worked out okay. And so, over time, just kept keeping my eye on this. And, this is all before the big boom that happened kind of at the end of 2021, or sorry, the end of 2020. But so back then it was kind of more steady Eddie, buy these warrants. One day you wake up and there's a deal announcement and you're really excited, or, there were a couple where they took out the warrant as part of the deal or in between announcement and closing. And so you obviously get really excited with that, but it always had me kind of focusing on the space. And one thing that I noticed as the space grew, it wasn't covered with the same institutional rigor that I saw my peers covering, financials at Citadel or consumer or technology, et cetera. And so I just thought that there's probably an opportunity to bring that kind of institutional coverage model to SPACs. And the fact that there's always a trade to make. Sometimes it's really exciting, like this warrant trade that I just described, but sometimes it's something as simple as SPAC arbitrage, which I think is a fine strategy, or it's, writing options on SPACs, or then it's, if you're a little bit bigger and have access to private markets, investing in risk capital, investing in pipes, and then ultimately long short equity. And so there's just so much you can do that, you don't have to be a slave to what's the opportunity today and that goes away. You still have trades. And right now with, upwards of 500 SPACs seeking targets and, the TAM, I hate using that word, but the opportunity set is just really large.
So I want to take one quick step back, because there might be some folks listening to this that are, they've heard SPAC, they might know what the initials stand for, but they might not understand the full overall structure. So can you explain to us the structure of the SPAC and then why it became so popular in 2020? And yeah, we'll start there and then we'll go.
If you only follow the media, you'll know that SPACs are the most evil financial product ever conceived of. But in reality, that's not the case. So the SPAC is a special purpose acquisition company. And the way it works is a financial sponsor raises money, say $100 million. And in exchange for that, you get a share of stock and you get a fraction of a warrant. And it could be anywhere between, we've seen them at 0.2 warrants per unit. We've seen them at 1. And what's really unique about the SPAC structure is the sponsor has a finite amount of time to find a deal. And when they find their deal, they make an announcement, they put out all these financial projections, and then you as the investor have the choice. Do you want to get your original $10 back, or do you want to stay in the deal? And so a lot of people, they ignore that fact. It's pretty unique where you get all this information and then your downside is protected. You can always get your $10 back. And by the way, your warrant builds value once a deal is announced and ultimately closed. And so, when you think about traditional SPAC arbitrage, that's what you're playing for. And so what's really cool is there's a way to play SPACs that is a completely risk-free product. And so why they got so popular, you can really attribute it to DraftKings. So all of a sudden, SPACs were a quiet product, a couple deals a year, and then DraftKings happened and created, all this noise and created a lot of value. And all of a sudden, if you think about back to 2020, following the trough of the market, risk assets really got bid up. And a SPAC was no different, just another form of, high risk equity. And so you saw that happen, and a bunch of SPACs were raised and they were pursuing the riskiest asset types, those that may not generate revenue today and probably profitability is years out. And they were initially well received. You think of like a Nikola, which became kind of the joke, but Nikola at one point, was $80 a share. And so the rest of the sponsor community says, well, if apparently the market loves these EV deals, let me go give the market what it wants and find EV deals. And so that, sentiment has obviously changed dramatically, but, that's really how it started. And all of a sudden, like everything else, people started making all this money. And so, the crowd chases the P&L, and, then we start having pipes, and we can get into some of the issues with the pipe market. But, just going back to your question, usually what we've seen in conjunction with announcing a transaction is a sponsor will solicit a pipe, which is a private investment in public equity from financial sponsors to guarantee a certain amount of cash to the target.
So I wanted to hit on the idea of risk when we're talking about SPACs, because you mentioned that, it is high risk. And I understand that it can be high risk, especially if the deal that they end up finding for it is, pre-rev, not profitable, maybe burning cash forever, but it's not necessarily the structure itself that's risky, but now that, with the success of DraftKings and some of these other names, it just now SPACs are hunting these types of companies to put into that vehicle, right? Like that's what really made it inherently risky.
Right. And well, listen, because of your ability to get your $10 back, inherently there's no risk, right? There's no risk from the time you invest, if you're investing at or below trust, up until the redemption deadline. At that point, you can always get your money back. And so it's after that point when it goes from a SPAC to an equity where there's risk, just like there is any other equity. And to exactly your point, you could have a sponsor that did a deal that's, one of my favorite deals. There's no real revenue for the next few years. And so that is inherently more risky than when you look at something that's generating EBITDA today and has a track record of, steady Eddie growth. Like, that's just SPAC or non-SPAC, that's a safer profile.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. I mean, what's some of the upside for these companies to go public via a SPAC versus, just a direct listing on NYSE or NASDAQ or any of these exchanges?
Well, it's interesting. Just going back to the media comment, the media has been pretty bearish on SPACs, but in reality, the challenges in 2021 were all new issues, right? You can think about Robinhood and Coinbase. Those weren't SPACs. Those are still equities that are trading well below where they entered the public markets. And so, I think as you think about, there's a bunch of different options. The SPAC route tends to be the fastest. As of now, you're able to disclose the most information because a SPAC transaction is considered a merger. In a merger, you're able to provide forecasts. In an IPO, you're not. But I have to, that always comes up, but I have to point out one thing. The dirty little secret is when you do an IPO, the guy at the big hedge fund gets to call the underwriter and say, like, what are the forecasts? And while you're not allowed to send anything in writing, you're allowed to read them over the phone. I've done this a lot in my career where you just sit there and you call broker one and you're like, hey, what's your analyst revenue forecast for the next 3 years in EBITDA? You call broker two, you call broker three, you make your own consensus, and then you have the numbers. And so that creates an information asymmetry between institutional and retail investors, which what I love about the SPAC product, it has its flaws, undoubtedly. But in terms of leveling the playing field, it certainly does that a bit. And so, just coming back, if you're in theory, you have a preset valuation, so you're not, we've seen all these deals where they revise the range up, they revise it down on an IPO. If there's a pipe involved, you have some sort of certainty on the minimum level of cash you're going to receive. You have the ability to provide more information and meet with more investors. If you think about the average SPAC takes about 4 months between announcement and close, and during that time, management can meet, an IR can meet with investors, even individual investors, and you can learn more about the story, decide, do I want to stay in this or do I want to ultimately redeem for my 10? And so those are just a couple of reasons why, you may want to go the SPAC route versus a traditional IPO or direct listing.
Gotcha. So let me ask you a question in terms of your own investing strategy in SPACs. I mean, do you actually even really care about the deal that actually gets done, or are you more tracking it for the trade? How do you think about it?
Well, so the thesis with which I decided to kind of pursue RLH is that there's always money to be made in SPACs, kind of what I was saying before, whether it's, you can be an investor in the sponsor, you can invest in the IPOs and look at these anchor deals, you can invest in, pre-announcement, post-announcement, common warrants, units, pipes, long, short, there's just so much you could do. But I'm the sole investment professional. And so there's only a finite amount of time that I have and a finite amount of capital. And so unfortunately, it didn't make sense to do all those things at once. And so the way I decided to start was on the safer end of the risk spectrum, thinking that, if I generate kind of some of these more steady Eddie returns, and then I see an opportunity, I can go back to my investor base and say, hey, I found something, this is a little more interesting, a little higher risk, but it's worth maybe allocating some capital and discussing. So do I care? Absolutely. Because if I'm owning DWAC, for instance, which has gone to the moon, that's a great way to make a ton of money instead of owning something where I'm going to have to redeem it at 10 because, they can't get the stock up. And so, and that's part luck, right? You never know when you invest in a SPAC right now, are they going to hit the 1 in 100? But the nice thing is all of your volatility is asymmetric to the upside. And so you don't have to worry about the deal going to $7 because you have that redemption deadline. But yeah, listen, I think it's good for the SPAC industry if deals are better received. Right now, and stop me if I'm going off tangent here, but
no.
Right now the average deal that's closed is trading at $7-8, and so then even if you see an interesting deal, you kind of tell yourself, well, all of these SPACs trade down. Why am I going to bet on myself to find the one that doesn't? And then that creates these issues of high redemptions and SPACs are bad, and then you have all these low float equities trading. And so from my standpoint, what I'd love to see is a couple, not a couple, but there's so many SPACs, a lot of really good deals. The market right now is clearly favoring cash flow generating value stocks versus, some of these higher growth, more VC type investments. Not that there's anything wrong with them, it's just market preference right now. And so I'd love to see kind of your beat and raise stories where all of a sudden people realize there are good assets that can come public through a SPAC. And, I'm hopeful that sponsors are really smart. They'll figure this out, but that's kind of the path to a more normalized SPAC market where you don't just get the media hating on SPACs.
Where does the hate come from? Like, why is there that media hate for SPACs? I mean, I don't really get it. It's just, it's just another.
Why
another
SPACs?
vehicle.
I think the more interesting question is why SPACs over, IPOs or direct listings we mentioned before.
Can I ask that? Come on, man.
Sorry.
I know what I'm doing. I know what I'm doing. No, I'm just kidding.
Why does the media hate SPACs? Because the average SPAC is down. You've lost a lot of money investing in SPACs, one. Two is a lot of SPACs have just missed numbers. And this whole dynamic of we're going to give you our 5-year forecast, but then we miss our first year number, it doesn't inspire a lot of confidence. And the other thing, and some guys in the media have harped on this, the incentives for the longest time, they're starting to get better now, have just been totally misaligned. And so, the way your typical SPAC works is the sponsor keeps 20% of the capital raised. And if you think about how that compares to, say, private equity, in private equity, the sponsor keeps 20% of the profit. And so you're effectively baking in that you're going to double your investors' money to justify this 20%. And so you can have a lot of situations, and I tweeted about one a little while ago where, the SPAC trades to 5 or 6, your public investors have lost 50%, and yet your sponsors are well ahead. And that's the type of stuff that, gets DC involved and whatnot. But lately you're starting to see more and more of sponsors forfeiting some economics, or more importantly, tying it to share price. Like, if you want me to believe your 2025 number, I have no problem with you as a sponsor getting rich because you crush your 2025 number. I just have an issue with you getting rich today, bailing, and you're not even there when the 2022 number gets printed. And so what's good about how, the way the market has grown is targets are more sophisticated. Bankers advising targets are more sophisticated. So you're starting to see more and more of those better aligned transactions. Got
it. All right. So, I was just kidding. I'm glad you came up with that question. So let's ask that. Why has there been this preference for SPAC versus an IPO for some of these companies?
Well, I think it's what I mentioned earlier. If you rewind the clock, SPACs were a great product, and so you wanted to partner with a SPAC, particularly a better known SPAC, because you get kind of that boost right away. And there's so many deals that traded well. They were able to redeem their warrants, and now they're trading below where their warrants were trading. It's pretty terrible. But listen, there's still good features of SPACs. We've kind of mentioned some of them in terms of the disclosure, the minimum capital. And candidly now, with markets a bit more volatile, we'll see if having a SPAC out there is really a value add. Like, you may not, if you're a really large company, well-known, it's always going to be easy to IPO. But if you're in the mid-cap space right now in a volatile market, you may not be able to IPO. You may not be able to get, a capital markets desk's, time and awareness. But hey, you've got about 600 SPACs. And, what's nice now is you can probably pick from the higher quality ones. Who do you think is, everyone's so connected, right? Who's in my network that I trust, that makes sense, and has expertise in my area. Jeffrey's put together a really interesting report showing that the key factor determining the success or failure of a SPAC is whether that sponsor has experience in the industry. And so I think you'll see more kind of aligned transactions as opposed to, these SPACs that would come out and say, we're going to do a deal in consumer, and then they, do an EV deal or whatnot. You just, that was more play the hot space and that's it. So I think you'll start to see more logical transactions.
So where are we at? I mean, you kind of alluded to this already, but like, where are we at right now? Is the SPAC market still, it's clearly not as hot as it was because there have been a lot of folks, that lost money from it, but it wasn't so much from the vehicle and the idea of a SPAC. It was more because the deals that were being sponsored were just not.
Yeah. And the example I always give to that is there was a Peloton competitor called Beachbody that came out through a SPAC.
Yep. Yeah. It's
really struggled. But if you graph it versus Peloton, they're both down 80%. It has nothing to do with one was a SPAC and one wasn't. It has to do with the fact that there are two fitness companies that are losing money, and the market decided that that's just not in favor right now. And so, I think it's exactly what you were saying earlier. I think it's more about the types of transactions that we'll see and hoping that these SPAC sponsors are smart enough to pivot and realize, there may not be something like EV in the middle of 2020 that, gets your stock up 8x, but you could still, bring a deal to market at a right valuation that can create value over time.
So, will there still be more, celebrity sponsored SPACs that I'd rather see celebrity sponsored SPACs than celebrity sponsored like NFTs in full fairness, but like, are we still going to be seeing that for the time being, or I don't know. That's probably not going to go away.
I think we're going to see some SPAC issuance slow. Obviously, there's already a bunch of celebrity backed or celebrity connected SPACs. I don't think we've seen many examples where the celebrity has added value in terms of sourcing a deal that the market likes, but hopefully that changes. Like I said, I'm rooting for the SPAC market, and I don't care if it's a celebrity or a savvy investor or a sophisticated operator. For me, it's just you want to see good deals that are, I think at this point, EBITDA positive and have a kind of a path to beating and raising numbers.
So do you think the SPAC market is just always going to be this kind of like volatile, all right, it's in vogue again because, that one deal another DraftKings just hit. Here we go. Everything else. Now everybody's going to go public via SPAC, or, oh, now they all, went to the more risky stuff and now it's going down. Like, is it just always going to be like this?
Well, what DraftKings did was it awakened all these investment bankers' eyes to, we should push SPACs. And so anyone who had, the general formula for how much money you need to raise a SPAC is $2 million plus 2% of what you raise. And then you can syndicate some of that out. So a $200 million SPAC used to be $6 million to raise it. And then if you don't have $6 million, you bring in investors to invest in your risk capital. And so what I think happened when you look at the 600 SPACs, give or take, that are out there today, you have a lot of people that shouldn't have a SPAC, like candidly. Like, it looked really easy. It was pretty cheap. The returns from risk capital were really high. And so that just brought a lot of people to the table, and at a point where almost any deal was well received. So you didn't have to be a savvy deal maker. You just had to be someone. And if you were, lucky enough to pair up with a Goldman Sachs, you could tap their M&A group, and they want to see a successful outcome for SPACs underwritten by them. And so that's kind of I don't want to call it a sure thing, but a high probability, trade that you're going to find a deal. And again, if you're thinking back in late 2020 terms, a deal that's going to be really well received, you'll get a quick payday and move on. And so I don't think it's going to be as volatile as you said. I think, there's just too many SPACs right now with 600. And I don't know what the right number is, but I think over time, what you're going to see is the 600 dwindle down to 100, 200, some much smaller number of firms that are capable of doing deals. Like when you see KKR has a SPAC, KKR's business is doing deals. So it's not surprising to me that this is just another vehicle, because they're on the hunt with a huge organization to hunt for deals, and maybe they find one that they think fits best in this wrapper. But when it's, 6 guys working out of like a WeWork, they have to be really connected and really differentiated in order to compete with the other 600 SPACs out there. And so I think you're going to see a bunch of liquidations. I'm a bit more bullish than some of the guys saying 50 to 70% because there's always deals to be done and they have a lot of promote that they can forfeit to help the terms. But I think you'll naturally see the market shrink. And one way the market's shrinking is through redemption rates, right? So if you look at the average January redemption rates, 82%. So 82% of investors in these deals don't want to go from the SPAC stage where they have the $10 floor to the D-SPAC stage where they're in, a traditional equity. And so in some way, that's the market shrinking itself. That can you imagine if all of a sudden of these 500 SPACs, the 150 billion or whatnot of market cap, if it's all but 20% redeemed, and all of a sudden we're saying 30 billion, and all of a sudden that's not such a big number. Now, again, as someone who's rooting for the SPAC market, 80% redemptions is a bad thing. So I hope that gets better. But you can see that the market is getting smarter and more discerning because at the beginning of 2021, we were seeing 7%, 15%, 12%, and now we're at 82. So, sponsors need to be much smarter about how they get a deal financed. And going back to pipes, the pipe market is pretty challenged right now. So, it's and what's really interesting is, at the risk of going off tangent, the equity pipe market is pretty challenged, but the structured pipe market, being convertible equity or convertible preferred equity and convertible debt, is wide open. And so you think about, well, what types of companies can support, an instrument where you have to pay interest or pay dividend, and it's cash flow generative companies. It's another reason why I think we're going to move in that direction. Although, we have seen some recently, which are back to the no profitability for a long time and the hockey stick forecast. So maybe I'm a little bit ahead of where the market needs to get to.
No, for sure. So one big phrase is used in the SPAC market quite a bit, and you see a lot of investors within our universe asking for sourcing on this, is the idea of a D-SPAC deal. What does that mean? And how does a company then get there?
So the D-SPAC is, if we go through the timeline, a SPAC announces a deal. There's about 4 to 5 months between the announcement and closing where they're preparing SEC filings, they're meeting with investors, then they hold a vote. And there's 2 parts to the vote. The first part is, as a shareholder, you're voting for or against the transaction, and almost everyone votes for because there's no reason not to. And then there's the redemption component. And those 2 votes are independent, which is really interesting if you think about it, that you can vote for a deal, but then, cash out your shares. And so at that point, if all of the closing conditions are met, the redemption floor goes away and it's no longer a SPAC, it's the underlying company. DraftKings, for example, is what we said. And once that happens, you can't get your $10 back, and it trades like any other stock.
Got it. So basically the D-SPAC is if it's post.
It's the completion of the M&A transaction.
Got it. So what is there anything interesting when you look at some of these I guess right now folks are just looking for the ones that are down the 50, 60% because they were risky transactions. Is that really what's been going on when people are looking for D-SPACs right now?
Well, so there's a few dynamics, right? The first is most of these D-SPACs are trading down. And so part of it is if they have a pipe, the pipe investors are allowed to start hedging their investment afterwards. So you have that negative technical pressure. And the other is just SPACs have such a poor track record right now. It wouldn't surprise me if you saw investors or algos kind of shorting them indiscriminately. And so that creates some near-term volatility. And again, the challenge with that is if you go back to, if there's a deal going on that you like, it's like, well, if I know there's going to be this volatility, I'd rather buy into that than before. But that's not the question you're asking. And so, what we've seen in these SPAC markets, there's the baby's been thrown with the bathwater. A lot of these deals are not great deals, but, at a certain price, something's really interesting. It's either interesting because it's cheap on valuation, or it's interesting because the risk reward, if they actually execute on their plan or a percentage of their plan, is really interesting. And so you're right. I actually posted on Twitter a couple of weeks back, here's a list of broken SPACs. And I define a broken SPAC as just trading under 10. That's EBITDA profitable, because at that point you can decide like, hey, there's real cash flow here. What's going to happen? And one such example that, I've been kicking around is Sunlight, ticker SUNL. And full disclosure, I own a little bit, but it's a really small position. So this was a SPAC backed by Apollo that bought a company that facilitates lending for solar panel purchases. So if you want solar for your house, you have the guy comes, sells it to you, and you need to finance it. He'll pull up an app, the Sunlight app, and he can facilitate financing for you. And so what's really interesting is this is a profitable company, trades at $3.42. Again, sophisticated sponsor who knows a lot about financing. And on street numbers now, this is trading at under 7 times EBITDA. And I just think that's really interesting for a company that's supposed to grow. Again, if you believe street numbers, it's supposed to grow EBITDA by 30% in 2022, and again by 40% in 2023. And I look at that and say, even if they miss these numbers slightly, for a company that has a net cash position on its balance sheet levered to a structural theme like solar, that looks really interesting. And so I think there's a whole handful of these, and they warrant investor attention. And it wouldn't surprise me if they eventually attracted private equity attention too, because you look like at an asset for under 7 times EBITDA that could be, that has balance sheet capacity for debt. That's a screaming LBO. And so it wouldn't surprise me if in the coming months we saw more private equity firms kind of hunting, because everyone complains that asset prices are so high, but I just quoted you one that's under 7 times EBITDA. So unless it's really broken, and maybe it is, that would be interesting to me as a sponsor. And like I said, there's a pretty big list because of how poorly these SPACs have traded. And I think, when you were asking what gets people excited again about SPACs, I think that could be, if you have a well-known sponsor come in and buy this out, even if it's not back at 10, but it's at $8, now all of a sudden you have investor eyes and capital coming back to this market.
What would you say is the most confusing, the part about SPACs that confuses people the most? I mean, because even for me personally, like when I'm asking lots of very basic questions about SPACs. Like I'm not even gonna pretend like I'm a SPAC expert or anything like that, supposing a lot of things based on your answers. Okay. So anybody listening that thinks I'm very much not. But what do you think confuses most people like me that aren't really following the SPAC market as closely, that they should maybe rethink or how to think about this?
It's probably all the dates. So the first date, you have an IPO. Then the second date after the IPO is when the units split and you can trade the underlying warrants and shares. And then the next date is the deal announcement. And then you have all the filings. And then the next date is the redemption deadline and the vote. And then there's the deal close. And then after the deal close, there's the PIPE registration, which could potentially lead to some selling. And so there's all these dates to keep track of. And sometimes people forget, when can I get my $10 back? The stock's at 8. I want my $10 back. It's like, well, you missed your deadline. And so to some extent, you have to track all those deadlines, but that's at the expense of protecting your capital, right? If you're worried that the market's going to trade down, but you invest in a deal, you can get your $10 back even if it trades down. So, it's a trade-off for that downside protection versus tracking these dates. But once that PIPE is registered, it's just like owning any other stock. Now, some people get confused because there's warrants and what's a warrant, and a warrant is just like a call option. But to someone who doesn't spend time, they could go on their computer and type in a ticker and say there's a unit, a common, and a warrant. What is all this? This is confusing. When I buy shares of Microsoft, it's just Microsoft. And so I think it's a combination of the units, the number of securities and the dates. But over time, the dates kind of take care of themselves. And if a SPAC deal works out, the units ultimately the warrants get redeemed, and you kind of end up at the same place. But while you're on that journey there's definitely a little more complexity.
Got it. What I mean, other than DraftKings, what prior to this new SPAC boom was the previous like SPAC darling that everyone was like, oh, this was SPACs are amazing. Like, we should all do SPACs. Honestly,
I don't think there was one. And so I'll go back to, my first SPAC investment was this company, it was 2015. It was a company called Lindblad, LIND. I'm not a shareholder anymore, but, if you go back and look at it, it's a really interesting timeline. So I'm just pulling up the stock price chart here. So this deal closed in summer of 2015, and the stock just sat at $10. Literally sat plus or minus 10 until March 2018. So almost 3 years. And during that time, my boss was not thrilled with me. Markets were going up, And what this deal was, it was a high-end cruise company and they needed capital for new ships. And as you know, or can imagine, you don't just get this money and go to the ship store and you buy a ship, right? It has to be engineered and designed and it takes time. And from some combination of the market just not willing to trust, or the fact that no one knew this company existed and it was small and illiquid, it was almost as if that first ship had to actually hit the water for the market to react. And then all of a sudden, the stock went from $10 to just under 20 before COVID happened. And so it actually played out. And if you compare the results to their investor presentation, like, sure, some things took a little bit longer, but this was kind of one of those, when, not if stories. But, I remember pitching this over and over, talking about how incredible this story is. And either people are like, whatever, I've never heard of it, or it's too illiquid. And so, I can't really, and, that same sponsor, who I actually have a lot of respect for, did another deal called Cision, and similar dynamic. I mean, it actually traded really well, peaked at 18, then ran into some operational issues, and ultimately they sold it for 10. So, depending on how you traded it, but again, small company, not so liquid. What really happened that was interesting with the boom, as you called it, is you had a lot of liquidity come into this market. You had retail coming in, and that created enough opportunity for institutional to play too. Now, some of the institutions got cute with these pipes. And so what they were seeing is these deals were being announced and being so well received that the $10 SPAC would pop 40, 50, 60, 80%. And they all wanted to raise these pipes to be able to have a minimum level of cash delivered to the target. And so all these, savvy investors came in and said, well, this is like an IPO that pops 50% on day one, except we can actually get a lot more. I mean, in my time requesting IPOs at hedge funds, the allocations were always terrible, and you get a sob story on why you requested $10 million worth and got 50,000. But here you could actually get a big chunk. The problem was you get in and all of a sudden you're locked in for 4 months. And what you saw happen with a lot of these deals is people were committing in early 2021. And by the time the deal closed in the summer, the market was totally different. And in a lot of cases, you saw, it popped 60% up to $16, hit 10 before the deal closed because you can't really go much below 10. And then the deal closed, and before the pipe is registered, it dropped, 30, 40%. And so it's just, so you kind of brought in the big guns with institutions, and then you burn them and they're kind of gone now. So, it's back to really needing to rebuild credibility here.
So where do you find the opportunity right now? I mean, do you see yourself as being a SPAC investor for the rest of your life?
Hopefully rest of my life is a really long time. I really enjoy going through SPACs. I think not a lot of people are doing it, and I'd rather hunt where there's less hunters. Like I said, I think the market is too big right now, and so hopefully that shrinks over time. When I look at opportunities right now, there's a couple I'd highlight. I think core SPAC arbitrage is still a good strategy. And so what that means is you're buying these units below trust value. So let's give an example. You buy something at 10 that has $10.20 in trust. And so I know if I hold this through expiration, and the duration of these SPACs is actually shortening, which is kind of a nice feature. But so let's just make it up and say for 1 year, I know that if I hold this piece of paper for a year, I make 2%. And then I have a warrant. Let's just assume it's a whole warrant. And if they do a good deal, and if a SPAC trades at around 10, the warrant is worth a little over $2. Most haven't been holding up there, but let's just talk about like the dream case. So all of a sudden, I have a $2 warrant. I've now made 20% on my investment with no risk. Like, that is a phenomenal return. And I'm not playing for that, by the way. I think playing for mid to high single digits is much more reasonable. And so to me, that's when I pitch investors, I say, look, on my SPAC ARB portfolio, I'm looking for, call it 7-8%. I run with some leverage, but 7-8% up and 0 down. And so that is a really compelling risk reward. And I think that's, it really depends on what's your cost of capital. Is that interesting? The average investor probably doesn't want to go on margin. So let's pretend they don't. Is a 7% return with no downside attractive or not? That's a personal decision. Then if you want to get some other strategies I do are kind of writing options against SPAC. So again, you're trying to capture a spread. If you don't like 7% for SPAC ARB, you probably won't like writing these options. It's a bit tedious and whatnot. And I like that it's tedious because it discourages a lot of other people from doing it. Then you can kind of migrate down the risk spectrum and say, well, what about these warrants? Warrants have come under a lot of pressure. They're down 20 to 30% since the beginning of the year. The average warrant right now is trading at, give or take 45 cents prior to a deal closing. And if a deal closes and it goes well, that warrant can be worth $1, $2, $3 or more. And so all of a sudden you're looking at a trade that has significant upside potential. Now, the downside is if a deal doesn't get consummated, that warrant's worth zero. So you are truly playing, 40 cents could be zero, could be multiple dollars. But, again, depending on your risk return threshold, that could be interesting. And what's interesting about that is you can play that before a deal is announced and just say, I really like this sponsor. I'm going to invest in their warrant. I think they'll do a good deal. I think they'll make you money. Or you can do it after a deal is announced and say, I studied this deal. It's really interesting. Why would I want to buy the common? I'd rather buy the warrant to get more juice to it. And then, once the deal is closed and it's a traditional equity, at that point, you can look at any security you want and say, I like this on the long side. I like this on the short side. And so there's just a lot of different ways to play it. I think the days of just assuming that I'm going to buy, a SPAC before it announces a deal and that the common will trade well above 10, those are probably behind us for now, just given some of the, de-SPAC performance. But the flip side is, you talk to a lot of SPAC sponsors and they kind of understand what they need to do to work. And they're kind of bracing for some short-term volatility. And I think that could be an interesting opportunity to get into a name you like. And I'll give you another example. So there's a SPAC called Queen's Gambit, and full disclosure, we own it in the fund. And they've already come out and beat and raised their numbers once. So, this track record that all SPACs kind of overinflate their estimates and then whiff, that may not be the case. Or you look at another SPAC, CND, also we own some in the fund, where, it's their business is primarily earning float income on their USDC. So for you crypto guys out there, you probably know a whole hell of a lot more of it than I do. And I know that there are some regulatory concerns, but if you just look at, the projections, how the business is tracking versus the initial projections, you can track USDC outstanding in real time, and they're running way ahead. And they assume no interest rate hikes, which based on, some of the news this morning and the CPI print, it seems like we're going to get some. And so they're kind of setting it up off the back to be able to raise their numbers. And so I think that these sponsors are just getting smarter and knowing that, we need to kind of position ourselves to beat and raise and have some positive outcomes. And again, I'm rooting for all of the SPACs to do well. I know they won't. Honestly, I know most SPACs will probably do poorly because they have to refigure out the playbook. But, there's going to be a lot of opportunity along the way.
Absolutely. So before I let you go here today, my last question for you is, what's your advice for new investors to SPACs or investors out there that have maybe dabbled? How should they think about SPACs moving forward in 2022?
You really need to pay attention to what point we are in the SPAC's life cycle and how much risk you're comfortable taking. To me, everything in investing is about what is the risk adjusted returns. And some investors are comfortable with low risk and some with higher risk. And so, right now, if you buy a SPAC that's yielding 3.5% and you can redeem it, that's probably the safest trade out there. Why you would rather own treasuries versus a SPAC, I don't know. A SPAC is backed by the same treasuries. So, you can really go to that, that safest place of, hey, I put all my money in CDs earning 50 basis points. Well, you can move that to a SPAC and earn more and potentially have some tax advantages. Or you can look at some of these deals and say, hey, I think these sponsors have figured it out. I'm willing to stay in this deal, but I know that once that redemption date passes, there's real risk here, just like any other stock. And so, I would say be really discerning about these deals. Memorize the timeline. SPACs are fairly transparent. They have to put out all these SEC docs that say when it goes X redemption, when the record date is, et cetera. And so if you kind of decide, why are you using this vehicle? Are you using it for some yield? Are you using it to play the deals? Are you using it to get warrants on the cheap? So it's just the same way we think about thesis creep in institutional investing. You kind of have to know, why do you own this instrument?
Very good. All right. Well, with that, Louis, where can our audience go and find more information, follow you? You said you had a Twitter account, right? So where can they follow you on Twitter, and then also your website to find more information on RLH?
No website, because candidly, I haven't quite figured out the SEC hedge fund marketing rules. And so I just figured no website is probably safer.
But on Twitter, that's fine. No, I'm just messing.
Well, I rarely talk about single stock names other than posting research and whatnot. But on Twitter, my handle is Val with Catalyst. I know it's really lame, but I couldn't think of anything better that day. At some point, I may change it, but Val with Catalyst on Twitter. My DMs are open. If you want to know anything about a specific SPAC you're looking at or want to talk with the market, feel free to reach out. I love talking about this stuff, as you can attest to. So,
yeah, absolutely. Well, Louis, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thanks, Robert. Appreciate it.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.